On the afternoon of September 23, 1998, 14 bankers who had spent their careers trying to destroy each other sat down in a single room at the Federal Reserve Bank of New York and were told they might have no choice but to save a firm they all despised. The firm was Long-Term Capital Management. It employed 2 Nobel Prize winners. It had never had a losing year. And in roughly 5 weeks, it had lost $4 billion. The question this episode answers is how a fund built on mathematical certainty became so fragile that a single sovereign default, in a currency almost no one outside Russia held, could come within hours of unraveling the global financial system. The mechanism is stranger than it sounds. And about 10 minutes from now, we'll reach the exact sentence William McDonough used to persuade those 14 competing banks to write the check, a sentence that has never sat comfortably in the historical record. To understand what long-term capital management actually was, you have to start in 1994, with a bond market that had just endured one of its worst years in a generation. The Federal Reserve, under Alan Greenspan, had raised rates 7 times in 12 months, 250 basis points in total, and every fixed income position that had looked safe in January looked considerably less safe by December. Out of that wreckage stepped John Meriwether. Meriwether had built Salomon Brothers' bond arbitrage desk in the 1980s into the most profitable operation on Wall Street. He left Salomon in 1991 under a cloud, a Treasury auction scandal that was not his personal doing, but that ended his career there regardless. What he carried out was a philosophy that mispricings in bond markets were systematic, measurable, and correctable, and that if you identified them with sufficient precision and held them with sufficient capital, the market would eventually return prices to line. Convergence-trading. You bought the cheap instrument, sold the expensive one, and waited. The only requirement was time, and enough money to survive until time delivered. He recruited accordingly. Robert Merton and Myron Scholes, whose work on options pricing had produced the Black-Scholes Merton model, the foundational equation of modern derivatives finance, joined the fund. So did David Mullins, who had served as vice chairman of the Federal Reserve under Greenspan. The management team was completed by a cohort of quantitative analysts from Salomon's old arbitrage desk, people who had spent careers building exactly the kinds of models Meriwether now intended to scale. The room, on paper, was the most credentialed in finance. That fact would later carry its own weight. The fund launched in February 1994. In its first full year, it returned 28% net of fees. Fees that were, by the standards of the time, extraordinary, 2% of assets and 25% of profits, against an industry norm closer to 1 in 20. Investors paid. By 1997, assets under management had grown to roughly $7 billion, and the fund had returned an average of more than 30% annually. What those figures did not show was the number underneath them. What the annual return figures did not communicate was leverage. LTCM was not working with $7 billion. It was working with positions whose notional value had grown by early 1998 to somewhere above $1 trillion. The equity base was the cushion. The borrowed capital was the engine. The ratio of assets to equity was running above 25 to 1. Every percentage point the book moved against them consumed a quarter of the equity beneath it. The core trades were not exotic individually. LTCM's basic strategy was spread compression. Buy an instrument trading cheap relative to theoretical fair value. Sell a closely related instrument trading rich, pocket the difference when the spread collapsed. On-the-run versus off-the-run treasury bonds, Danish mortgage bonds versus German bonds, Italian sovereign debt versus German sovereign debt. Each trade was, in isolation, a modest bet on a small price anomaly closing. The extraordinary part was not the bet. It was how many of them there were and how much capital sat behind each one. In about 3 minutes, we'll look at the single line buried in LTCM's own internal risk report. a number their models generated and their principals chose not to act on. The models were built on volatility estimates and correlations drawn from historical data, typically the previous few years of market behavior. This was the first structural assumption baked into the machine. The models assumed that what had happened recently was a reasonable guide to the distribution of future outcomes. They assigned near-zero probability to events that had not appeared in the calibration window. Russia defaulting on its own domestic debt in ruble, debt it could simply print money to service, was precisely the kind of event that had not appeared in the window. It was also, by the summer of 1998, the event approaching. The second structural assumption was correlation. LTCM ran positions across dozens of markets simultaneously. The diversification logic held that the positions were uncorrelated. A widening in Danish mortgage spreads had nothing to do with Italian sovereign spreads, which had nothing to do with Japanese government bonds. In normal market conditions, this was not an unreasonable assumption. In a panic, it was catastrophically wrong, because in a panic, investors do not sell what makes analytical sense. They sell what they can. And when every seller needs liquidity at once, every market moves in the same direction at the same time. Roger Lowenstein's account in When Genius Failed, published in 2000, reconstructs the internal debate during this period with unusual specificity. By 1997, several counterparties, Goldman Sachs among them, had grown nervous enough about LTCM's size to begin quietly reducing their own correlated positions. The fund's management knew it had become so large that it effectively was the market in several instruments it traded. When LTCM needed to exit a position, it would be selling into a market that already knew it was selling. The spread would not compress. It would widen. And the partners knew this. The partners' response to this concern was, in retrospect, the clearest single signal that the machine had lost its calibration. In late 1997, they returned $2.7 billion to outside investors, reducing the equity base while maintaining the full size of the trading book. Leverage, already extreme, increased further. Their reasoning, as reconstructed by Lowenstein, was that opportunities had become scarcer and they preferred to concentrate capital in the highest conviction positions. A more generous reading is that they believed the models. A harder reading is that they believed the models past the point where the models deserved belief. The distinction would cost them everything. Russia in 1998 was a country living on borrowed time and borrowed money simultaneously. The Asian financial crisis of 1997 had already destabilized emerging markets globally. The price of oil, Russia's primary hard currency earner, had collapsed from above $20 a barrel to below 11. The ruble was under pressure. The government was rolling over short-term domestic debt, the GKOs, at yields that climbed through the summer toward 60% and above. The numbers were pointing in one direction. The IMF extended a loan package in July, the largest in its history to that point. It was not enough or not fast enough. On August 17, 1998, the Russian government announced simultaneously that it was devaluing the ruble, declaring a 90-day moratorium on private sector foreign debt payments and restructuring its domestic GKO obligations. That last element was the one that broke the system. Russia was not defaulting on dollar-denominated debt it could not print. It was defaulting on ruble-denominated debt it absolutely could print. The decision reflected a political judgment that inflation was a worse outcome than default. Whatever the reasoning, the effect on global credit markets was immediate and severe. What that effect looked like inside LTCM's own positions, specifically the single-day loss figure recorded in their books on August 21st, is something we'll get to in about 4 minutes. Spreads that had spent 3 years compressing began to gap. The flight to quality was abrupt and indiscriminate. Investors bought U.S. Treasuries and sold everything else. The spread between on-the-run and off-the-run Treasuries, one of LTCM's most basic trades, widened sharply. The spread between investment-grade corporate bonds and Treasuries widened. The spread between mortgage-backed securities and Treasuries widened. Everything LTCM owned cheaply went cheaper. Everything it had sold short went more expensive. The correlations that the model assumed would remain stable collapsed into a single number: 1. In a panic, everything moves together. From August 17th through early September, LTCM lost roughly $500 million per day on the worst days. The precise per-day figures are reconstructed from Lowenstein and from the President's Working Group on Financial Markets report published in 1999, which remains the most authoritative public accounting of the episode. By early September, the fund's equity had fallen from roughly $4 billion at the start of the year to below $1 billion. The leverage ratio was no longer 25 to 1. It was approaching 100 to 1. Here is where it gets stranger than it looks from the outside. LTCM's problem was not simply that it had lost money. Banks lose money. Funds lose money. The problem was the size and structure of the positions it still held, and what would happen to the rest of the financial system if those positions had to be liquidated into a market that already knew they were there. This was not a firm that could fail quietly. The fund had outstanding derivatives contracts with essentially every major Wall Street bank: Merrill Lynch, Goldman Sachs, Morgan Stanley, Lehman Brothers, Bear Stearns, Deutsche Bank, Societe Generale, and a dozen others. The counterparty exposure was not uniformly distributed. Some banks were far more exposed than others. But in aggregate, a disorderly liquidation of LTCM's book would require those banks to absorb losses on positions they held on the other side of the LTCM trades, at exactly the moment when every other spread in the market was also moving against them. The losses would compound. The question was whether they would compound in an orderly way or not. Gary Gorton and Andrew Metrick, writing in their 2012 survey of financial crises published in the Journal of Economic Literature, described the LTCM episode as one of the clearest pre-2008 demonstrations of the systemic feedback loop. A large institution's distress becomes the market's distress, becomes the institution's further distress. The mechanism is self-reinforcing, and, past a threshold, cannot be stopped by the institution itself. The only remaining question is whether something outside the institution will stop it, and what that something is willing to pay. Meriwether understood this. In late August, he circulated a letter to LTCM's investors and counterparties, describing the fund's situation with an unusual degree of candor. He asked for $2 to $3 billion in new capital. He received initially almost nothing. George Soros's Quantum Fund and Warren Buffett reviewed the situation. A consortium, including Buffett and Goldman Sachs, made an offer for the entire portfolio in early September, at a price that would have left the existing partners with virtually nothing. Meriwether declined. The gap between what a distressed buyer will pay and what a distressed seller will accept is almost always wider than it looks, and the clock does not wait for the gap to close. This channel exists because the interesting part of every financial crisis is precisely this interval, the moment between when the math stops working and when the institutions decide what to do about it. Subscribe if that interests you. The Federal Reserve Bank of New York occupies a building on Liberty Street in Lower Manhattan that was designed to suggest, deliberately and successfully, a Florentine Renaissance fortress. Its president in September 1998 was William McDonough, a former banker from continental Illinois, a man described by contemporaries as deliberate, politically cautious, and possessed of a precise sense of where the Fed's institutional authority ended and where it could not follow. He was about to test that boundary. McDonough did not want to use public money to rescue a hedge fund. The record is clear on this point. The New York Fed's own internal documentation, portions later released and analyzed by Peter Bernstein in Against the Gods and by Roger Lowenstein, shows that McDonough was acutely conscious of the moral hazard argument, that a publicly funded rescue would signal to every levered fund in the world that catastrophic risk had a floor beneath it. He was equally conscious that the Fed had no legal authority to purchase LTCM's positions directly. He needed a mechanism that was neither of those things. Near the end of this video, we'll read the exact phrase McDonough used in the room on Liberty Street to describe what he was constructing. A formulation that one attending banker later said no one present entirely believed. What McDonough did instead was convene. He called the chief executives of the 14 banks most exposed to LTCM and told them to come to Liberty Street on September 23, 1998. The meeting lasted most of the day. What happened in that room was not a negotiation in any ordinary sense. What he said in that room has been reconstructed from several accounts, most authoritatively from Lowenstein. The essential argument was not a moral appeal, and it was not a direct order. McDonough told the assembled bankers that the New York Fed had examined LTCM's books. The fund's positions were so large and so entangled with the bank's own positions that a disorderly liquidation, the kind that would follow a bankruptcy, would produce losses that would fall on the banks themselves. The rescue was not an act of charity toward LTCM. It was an act of self-preservation by the industry. This is approximately 10 minutes in. Here is the sentence I promised at the start. McDonough, as reconstructed by Lowenstein, told the room something to this effect, that he was not there to ask them to do anything for long-term capital management, but to ask them to do something for themselves. The Federal Reserve was providing the room and the accounting. The decision and the liability was theirs. 14 banks, direct competitors in every market where LTCM had operated, agreed to contribute a collective $3.6 billion to a recapitalization that gave them a 90% stake in the fund's remaining portfolio. The existing partners retained 10% and were required to stay on to manage the orderly unwinding. That process took until late 2000 to complete. The competitors became effectively the owners of the position they had each helped inflate. The contribution was not equal. Merrill Lynch, Goldman Sachs, and several others came in for $300 million each. Bear Stearns and Lehman Brothers declined to contribute. The internal dynamics of who pushed for the deal and who held back have been partially reconstructed, but the full picture remains incomplete in the public record. That two of the firms that declined would themselves fail within a decade is a fact the record does not require us to editorialize about. By the end of 1998, spreads had begun to compress again. The positions LTCM had held were not directionally wrong. The models had been correct in their underlying logic. The on-the-run, off-the-run Treasury spread did eventually narrow. Italian sovereign debt did converge toward German bonds. The convergence trades converged. They simply took longer than the fund's capital could survive. In finance, being right too early is functionally indistinguishable from being wrong. The President's Working Group report, released in April 1999, identified 3 structural failures the episode had exposed. No individual bank could see how many other banks held similar positions against the same counterparty. Counterparty risk was invisible in aggregate. Disclosure requirements for large hedge funds were insufficient. The leverage and concentration inside LTCM had been invisible to the public record. And the existing bankruptcy framework was poorly designed for firms whose primary assets were complex derivatives contracts. 3 clear findings, each one pointing toward a fix that did not come. None of these 3 problems produced significant regulatory action before 2008. Merton and Scholes received the Nobel Prize in Economic Sciences in October 1997, 1 year before the fund's collapse. The prize was awarded for their work on options pricing theory, which is legitimate and durable. The irony that the ceremony occurred while LTCM was building toward its crisis is one the history has not been able to put aside, though precision matters here. The models were not wrong in the way the popular account suggests. They were calibrated on a world that in August 1998 temporarily stopped being the world. That temporary stoppage lasted long enough. It took the fund with it and left the theory intact. What the LTCM episode foreclosed, definitionally, was the proposition that mathematical precision could substitute for capital adequacy. That proposition re-emerged in the mortgage-backed securities markets of the mid-2000s, in the structured credit vehicles that several of the same 14 banks constructed, and in the confidence that risk had been distributed away from the institutions that originally bore it. McDonough's room on Liberty Street held the line in September 1998. The argument about where that line should be drawn, and who should bear the cost of drawing it, did not resolve in 1998. It was only deferred. The next episode examines the instrument those same 14 banks used to move that argument forward, a specific class of structured vehicle whose prospectus language, in one case, recycled a phrase that first appeared in LTCM's own investor letters. If this got you, the next episode on this channel is about the night in September 2007, when depositors queued outside a British bank for the first time in 140 years, and why the Bank of England let it happen.